What a day. What a day. Stocks did not like what they heard today. It would seem. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at Tasty Live. And just when it looked like things would be all good, they are decidedly not. Wall Street getting punched in the teeth today from right around the afternoon. The Nvidia earnings overnight apparently not that encouraging, considering it was the smallest upside surprise on the EPS and the revenue numbers in over a year. Fourth quarter of 2022 is the last time we had anything in the single digits on both metrics. And it doesn't look like the stock split really impressed anybody either. But there was more to this story than just that. There was quite a bit of liquidation around the much stronger than expected U.S. PMI numbers as well. They came in substantially stronger than was anticipated. The composite number for the U.S. That takes in both the services and the manufacturing side was close to in line with expectations, but surprising strength for the service sector. And what that did seemingly was give a much more hawkish perspective on what the Fed might do next. So to give a sense here, the composite was expected at 51.4. It came in at 54.4. And that's because the service sector was expected also at 51.4, 51.3, and came in at 54.8. So a big jump in service sector performance. As a matter of fact, this was the strongest performance for the U.S. service sector since May of 2023. So we're talking a year, and the market certainly noticed. But now the question is, okay, well, we got something of a blowout here. What's next? Because we are looking down the barrel here of a 4-day weekend. Markets are going to be closed in the U.S. on Monday for the Memorial Day holiday. Liquidity tomorrow should be fairly thin. There's not really a big calendar event to capture the market's imagination. And so it's possible that what we're looking at here was a sort of, we've gone a long way, let's not have exposure over a long weekend, let's divest, let's rebalance portfolios to something a little bit less net long. So perhaps this is nothing. Perhaps this isn't anything that can be extrapolated into a larger story. And it is here that it starts to make sense to have a look at what's on the calendar for next week to see how much follow through on some of these moves we might expect. With that, let's begin the conversation in chronological order in Europe. What we're looking at here is going to be the next update in Eurozone CPI data. The expectation that on the headline number, we're going to tick up slightly from 2.4 to 2.5%. Now, this is not the world's most impactful increase. And of course, we are very much near the 2% objective here for the ECB. So this doesn't so much derail expectations of rate cuts, but it is noteworthy here that where we've obviously been looking at stalling disinflation in the U.S. and really focused on that, and the Fed has not just in the minutes, of course, this week, but in overall commentary, minutes from the May policy announcement, but in speeches from Fed officials, really started to signal that they're not quite so sure that disinflation has really and truly been locked into the point where they can begin to cut. There's a little bit of a flatlining here in the Eurozone as well. But when we look at the components, they are much more forgiving. So whereas in the US, and we'll look at this in just a second, the stickiness seems to be around the service sector. Here, it's more the hospitality side of things. So last year, it was all about food. That has receded significantly. This was by far the biggest contributor last year. The year before that, it was energy. I mean, we can see that here. So here's 2023. We can see a big contribution here from food. And in 2022, a big contribution from this housing, water, electricity, and gas component, which is just the cost of energy. And not surprisingly, there was a spike here with the outbreak of the war in Ukraine. All of that has now essentially dissipated, and we are in a much more even-handed disinflation. We can see that the biggest sort of contributor here, there's some assorted things here in this miscellaneous category, but the real standout is this: restaurants and hotels. And of course, that's a function of discretionary spending. Now, when we look at what's going on in the Eurozone, we do see that, and we just saw it again with the PMI data that came out earlier today, we have a little bit of an improvement. The Eurozone was contracting for 9 consecutive months until it emerged out of that contraction back into positive territory in March. We got some slightly better than expected Eurozone PMI data, suggesting that that improvement continues. The composite measure there showing us that we are at this point growing at the fastest rate as of May in the Eurozone, with a composite PMI of 52.3. The highest rate since the contraction started back in June of last year. So we've kind of narrowly returned into positive territory, and at least for the past, let's call it 3 months here, growth in the Eurozone has broadly accelerated. But after 9 months of contraction, there's quite a bit of growth you need to do just to get back even. So the overall economy remains weak. What's more, if we look at the way that Eurozone economic data has tended to perform relative to expectations, we can see here was the foreshadowing of what the improvement would be. This is data starting to turn, but now it's starting to go the other way. And we can see the magnitude of upside surprises here is diminishing, which would suggest that maybe we've kind of gotten through a weak patch. Obviously, we can see that toward the end of last year, there was a recession here marked by the gray bar. But now that we're out of it, and now that we've kind of started to grow a little bit, perhaps these expectations are starting to get more anchored. They're starting to get more benchmarked to the new reality of positive, but nevertheless sluggish growth. And so that would seem to suggest that this more discretionary component should fade over time as the toll of weak economic activity ultimately bites. And so if we get numbers here that are not staggeringly higher, we should say, than expected, then perhaps what we are looking at is a situation where rate cuts remain very much on the table, and indeed that's what seems likely. If we look at what is expected here for the tally here, 70 basis points being priced into benchmark ESTR futures, the first cut on the menu by July. And then from there, at least one more on the menu by November, and some strong optionality for a further cut by the end of the year. So we're tilting toward three. That third one has been relegated to less than fully baked in at this point, but we're closer to it at 70 basis points than we are to 50. So it's likelier that we get three than two at this point. And of course, that's not great news for the euro, which had an ugly day today and has been declining for the past week since it peaked in the wake of those US CPI numbers last week. So perhaps we get some follow through if these numbers comply and keep those rate cuts on the table, sending the euro still lower. Then we are going to get PMI numbers out of China. And we can see that although we had a bit of a pop in March, so services seem to be really building into that March set of numbers, we've now basically receded back. So the expectation is that we are looking at essentially standstill when we consider the setting of both manufacturing and service sector growth. So expectations here for both of those to come in just a hair above 50, of course, as ever in the logic of PMIs. 50 is neutral, neither growth nor contraction. Under 50 is contraction. Above 50 is growth. We can see here that really since the reopening in China, we've essentially just decelerated into this quiet standstill. And although there was a bit of a pop at the start of the year, and it makes sense why there would be one, there's typically an upswell toward the beginning of the year in China, even just around the holiday period. Lunar New Year celebrations typically are toward the end of January and into February. So you generally see some kind of extra life around the first quarter. We seem to be starting to kind of fade off that here. So January, that there was a bit of a bottom. February, right around that Lunar New Year thing, that we tend to see that seasonal effect. You get the pop. In the subsequent months, you can see you're starting to fade out. So as you get into these May numbers, it looks like you're essentially coming back to what is a sort of standstill benchmark. Looking at the way that this has performed relative to expectations, in the red is the economics surprise index. In the blue is Chinese shares. The CSI 300 is the composite of both Shanghai and Shenzhen bourses, the top issues there, and sort of the equivalent in China of a kind of catch-all S&P 500 kind of index. We can see here that this has done reasonably well since the beginning of the year, and you can see that economic data was in fact getting better relative to expectations during that time. But right around the beginning of April, there's been a divergence. And it's not surprising, because what we know, of course, with Chinese stock markets is there has been official decree for the quote-unquote home team, the investment arm of the sovereign wealth fund in China, to buy local stocks. in a bid to improve sentiment. And so what we've seen here is essentially a situation where stocks are going higher, but the economic data is actually weakening relative to forecasts. So it would not be, in my mind, the thing to do to look at the performance of Chinese stocks and say, oh, goody, things are going better in China. No, they're just buying a ton of their own stock. So when you look at the global growth implications of this, China is, of course, something like a fifth of global GDP before we account for all the vendor economies that depend on it. And so when we consider what is at stake here in terms of global growth, if we get this kind of weakness and the PMI data skid back towards standstill, and if this deterioration relative to forecasts holds maybe even weaker, the place you might see it is in sensitive to sentiment types of assets. And when it comes to China, the Aussie dollar comes to mind. It attempted to break the top of a 4-month range in the wake of the restart of U.S. disinflation with that CPI release last week, but it has since fumbled. So although it hit that breakout point seemingly last week, it has since stalled and has now broken back into the 4-month range that it ostensibly broke out of, setting the lowest levels in basically a week here, a little over a week, back to flirt with the 66 level on 6A. So from the looks of it, it seems like perhaps there is some scope for downside follow through here. And of course, if Chinese data suggests that demand from China, given Australia is looking to China as its largest trading partner, that demand is going to be weaker, it could be that the entire uptrend from late April in the Aussie has now been overturned. So 65, 50, 60 maybe a kind of next line in the sand. But if this data disappoints, retesting under 65, maybe even under 64 back to the April lows doesn't seem like it's out of the question. Certainly, we can see the situation in China still looking dire. For 4 consecutive quarters now, real GDP is above nominal, which is not what you're supposed to see. Nominal GDP is economic output growth minus inflation. Well, if that number is lower than real, if the real number, which excludes inflation, is higher than the nominal number, which includes it, then the inflation coefficient is negative. And when things go on discount, when prices are falling, that's not because demand is robust. It's because there isn't any demand. And inventories need to get cleared. So the actual underlying economic conditions in China clearly still very weak. And then we close out the week on the Fed's favored inflation indicator, the PCE price index, slight further disinflation expected here from 2.6 or from 2.7 to 2.6 on the headline, from 2.8 to 2.7 on the core. And what we're seeing here might well endorse this idea from the Fed that when they revise their forecasts in June, they're going to have to come in from 3 cuts more to something like 1. And we can see that here. So if we look at what's actually being priced in at the moment, it's 27 basis points for the year. So that's 125 basis point cut and only about an 8% chance of a second one. What's interesting is that this has been fairly even here. It hasn't really gone very far. Basically, through the last Fed meeting, through the CPI data, and if the PCE numbers really just don't give us any surprises, never mind register meaningfully hotter, then it could be that whatever optimism was had here, because the repricing seems to have stopped, could drain away. So as long as these numbers give the clear for sellers, that might very well be enough for a risk off backdrop into the end of next week. And that is macro money for today ahead of this holiday weekend. Thanks very much for joining. We'll be back with this show on Tuesday through Thursday next week. Back to normal scheduling Monday through Thursday the week thereafter. You can catch me on overtime as well next week. Same scheduling. Back with Victor Jones for the Price of Truth on Wednesdays. No first call on Sunday next week because of the holiday. That comes back the week after that. Futures Power Hour is tomorrow. We're on for that, so do come and join me for that show. I'm also writing for the News and Insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Have a great holiday. If you're celebrating, see you next week.